not in venture, you see on the news these exits and you're like, oh, wow, that founder must have made a ton of money, or like that was really successful, but actually it wasn't. Nobody maybe made any money.
Sometimes you get some return back to the investors just to say that there's some kind of return. Sometimes you see these numbers that are just like astronomical on an exit, and it could be that that's just maybe less than what was plowed in from the investor's perspective. So you might see a $200 million exit, but that may actually be less than the money that they took in, which isn't a great result, but at least you're getting money back.
A founder's ability to trust you as a VC and be willing to take that guidance seriously, it can be hard if you don't have a background that is clear, that you know what you're telling them is probably the right thing.
It's a hard business, like to do this, knowing that most businesses fail, and it's kind of believing in yourself. I think a lot of them like to believe that if they can just get through this, it's going to be okay. And I think being in a place where you can credibly guide them, I think is important.
Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital. And this season is about inside baseball, all the inside baseball things in VC. So today's episode is going to be about what happens when a deal goes south. So what happens when an early stage company or venture-backed company doesn't do well and doesn't have a sort of like positive outcome. How do VCs get their money back, or what happens in that scenario? Like, what are the options? And I've got Tony Chan on, who is one of our LPs in our fund and a great investor and has a ton of experience with this sort of thing. So before we get started, Tony, maybe why don't you introduce yourself and just share a little bit about your background?
Great. Thanks, Paige. I'm Tony Chan. I'm a partner in the M&A group at ORIC, and I've been doing representing investors in VC and growth equity companies for over 20 years now. And along that time period, I've also done quite a bit of investing, angel investing, and venture capital investing myself. And it's been an interesting period to be in that space. So I started in the early 2000s and been through a couple of different market cycles. And I think it'll be an interesting ride for the rest of this year.
Absolutely. That's a whole other episode we should probably talk about. So this episode came up because someone in our audience actually asked, people outside of venture, it's like if you buy a Prada jacket and you don't like it anymore or whatever, you can resell it on the RealReal and get 70% of it back. And that's the end of it. Yeah, that's how you kind of like sit the purchase. But it's like, how does that happen in VC, in real business dealings? So I guess you've seen a lot of these. What do you think is the most common? I have from what I've seen, but I'm speaking from being a VC and you're speaking from a different perspective, but what are the most common scenarios that you've seen for exits that are, not so great?
Yeah, I mean, I think that's a great analogy. This isn't like a Prada jacket. These are like securities in an illiquid company, and it's usually an illiquid company that is either cash flow negative or maybe they're cash flow neutral. And the question is, what do you do when you see that it's not going to work, right? It's not going to be the exit that you expected. And it could be that the company is just not viable going forward. So it really depends on where the company finds itself at that point, especially for early stage companies. What we see most often is just that they just wind down. There's a runway. You may have raised enough to get you to a certain inflection point. You maybe got to that point and realized it didn't inflect, right? It just didn't get there. And then you just say, we're going to call it, and call it a day, and you wind down, and hopefully you're able to pay everybody out, at least your employees. And then at that point, if there's anything left over, that goes back to the creditors. And then if there's anything left for the creditors, it's not normal unless you wind down early enough where you've raised an excessive amount of capital that you kind of give money back to your investors. There's a whole host of other situations that might happen as well, but would love to hear what you're seeing on the post.
I think that's the most common from our perspective as well. But I think we also see scenarios where sometimes there's no exit. Like the company is just, we may take we decide that we're done with it and we take a tax write-off and we're writing it off, we're done. But the company is still out there, sort of like maybe it's skin and bones, like they don't have any cash, but they still have their product, and maybe the founders, still trying to drive it forward or pivot it, something like that. But there's a lot of these like zombies in portfolios that people have, that they may not be taking loss for various reasons. They don't want to show that they took a loss if it's a fund or they're fundraising, but they still kind of like have these companies hanging out. We don't really like that, so we try to exit them. Obviously, we want closure and to move on and to make the right calls, but that's a common one. And then the other one I would say is like exits where like you see a lot of exits. It's really eye-opening when you're in venture. When you're not in venture, you see on the news these exits and you're like, oh, wow, that founder must have made a ton of money, or like that was really successful. But actually it wasn't. Nobody maybe made any money in the exit. It was more like an acqui-hire type situation. And you don't know that on the outside. Like the PR exit is like a positive one, but on the inside, it's not really, you can hardly call it an exit. It really is more just like a graceful way of winding down the company or giving somebody employees another job at another company to transition them. So we see that one. But
Yeah, that's a good point. I mean, that's a best case scenario for some companies that would otherwise wind down or implode, that they just find a soft spot to land. And sometimes you get some return back to the investors just to say that there's some kind of return, but a lot of times, to your point, there's nothing there. But you do see, sometimes you see these numbers that are just like astronomical on an exit. And it could be that's just maybe less than what was plowed in from the investor's perspective. So you might see a $200 million exit, but that may actually be less than the money that they took in, which isn't a great result, but at least you're getting money back, which is better than some of the other alternatives.
yes, so that's a super, super good point, I think, because a lot of times when the company has continued to raise capital, it's stacked on capital. They have liquidation preferences and they're going to get whatever is left over in the exit, but not all of the investors are getting anything back. So it can be a different, it can be a different success story depending on which investor you're asking in that exit scenario. And I think most people don't really realize that. But
I think we've been in kind of a period, at least where people have been I think terms have been very friendly towards the companies, right? So that you're seeing, you hear different series A, B, C, D. It used to be, when it was a little bit tighter, that was actually a true liquidation pref, and it stacked sequentially on top of each other so that the last money in would be the first money out. Whereas I think over the last 10, 12 years, it's become much more common to see pari passu series of preferred, where all of the preferred kind of exits on the same level basis, so that last money in may be at the highest valuation, but there's not a priority vis-a-vis the early money in. So it could be
that's.
are
Are you seeing that start to change?
It really depends. We thought that was going to change when the venture market dried up a little bit, but what we saw instead was full funding specific companies that they thought were going to be successful, and those companies still have leverage because there was a lot of people interested in investing in them. It's the companies that weren't quite as sought after that were having to turn to some of these participating preferred instruments, which are particularly brutal to earlier stage investors. And especially you couple that with a decline in valuation and your later stage investors who come in theory, with rescue capital in some sense, really do very well at the expense of the common and the early investors.
Yeah, and I think it's a good point in the 2022, 2023 era that you see a lot of maybe these companies that they just didn't have venture scale returns, right? So like the original investors, they're not going to be a winner in that portfolio. There's no way. If you're an early stage VC and you want to get maybe a 50x return, that's what you're hoping for in every investment. You're only going to get it one of maybe 10 or 20 times, but that's what your investment thesis is when you write that check. And the companies that aren't able to deliver venture scale returns, then they're kind of just sitting there. So we've seen a lot of in that era of 2022, 2023, a lot of recaps,
Yep.
right? Like a lot of these other investors coming in, completely recapitalizing the company and getting much better economics and taking some of these liquidation preferences. Almost like PE firms doing it more so than VCs. And so that's just another scenario.
Yeah. But it is interesting because it used to be that there was a distinct kind of difference between PE growth and venture. And I think over the last, again, 10, 15 years, they've kind of melded together. So you're seeing kind of late stage growth kind of meld into private equity, and then kind of even late stage venture go into growth or even kind of private equity type structures. So it's interesting that people are you're seeing different participants historically who have not played in that space. And then I think that drives kind of changes in terms and thinking about what happens on either an exit or a liquidation, right? And this, we're talking about what happens if it's not an exit that people are particularly happy with. I think the VC guys may have been happy to say, well, okay, we're just going to write that one off and hopefully the next one's a 50 bagger. Whereas the PE guys or the growth guys may be thinking, well, no, there's some way to salvage some of our liquidation prep. We're going to try to do that. Or we're going to position ourselves to be in the room, to have that discussion versus just, we're just going to call it quits.
Right. And I actually think sometimes maybe the more important question to answer for this audience, like if you have a company that, what do you do with it? How do you get your money back? Maybe you can't, right? Maybe there's no way to get your money back at that point, or you're selling it off for parts, or all of these scenarios that you just mentioned, Tony. But I think the more important thing is like as a VC is realizing when that's starting to happen sooner and having more options at that point in time. Because if you wait until it's too late, then you're kind of going to fall into those situations. But if you realize it sooner and can help the company figure out how to pivot or maybe exit, right? Like maybe when you realize that there's cash in the bank, they have 2 years of runway, but they're just not, it's just not working. But recognizing that at that time maybe gives you some interesting exit M&A situations. Then if you wait 2 years and you're sort of like, there's no cash left and you're sort of like your back's against a wall, then that's when it becomes a scenario where maybe you don't get your money back at all, or maybe you only get, 20% of it back, something like that.
Yeah, I mean, it's much better to have those conversations early when you have options versus as you get closer to the end of your runway, your options start getting narrowed, right? And I think that's exactly what you're talking about is things that could have been done in terms of a pivot or maybe a reduction in cash burn. It's too little too late once you get closer to that edge. I think you can attest to this, but I think for most VC investors, there's it's the problematic ones, the ones that are not doing well, that take up, the vast majority of your time. And it actually takes away from your ability to focus on helping the ones that are actually more, maybe have better prospects. Usually those are they're fine being on their own, but you could actually help them along even further if you had time that you weren't dedicating to trying to salvage the ones that, you're lucky if you get your money back. But at the end of the day, maybe you just kind of say, we're going to cut our losses and let this one go because it's not worth our time to spend to get 20% of our money back when we can actually spend that time to try to make this one a much more sure bet at a 3x or a 5x.
That's exactly right. And it's such a tricky balance because you do want to make sure that as a VC, you're spending your time on the value creating activities that are going to make your returns for your investors. But you're right. Like it is the ones, sometimes you have ones in your portfolio that you know that they still have potential. And if they can just a little bit of support and guidance can get them to a different situation in 12 months from now, then we think it's worth it. But sometimes sometimes that's just not the case, right? Or sometimes you have a founder or a team or a board, maybe which you don't have control over, that has taken control and is setting the direction of the business, and there's not really much you can do. And trying to spend a lot of time on those ones is just sort of, you shouldn't do it.
Yeah, you bang your head against the wall, right? Yeah, you can try, but it's probably not going to make much of a difference. But I'd love to get your thoughts on, because a lot of times as you're, it sounds great to say, okay, we're going to have the conversation early while we have options, but there's kind of a misalignment of interest there as between kind of the VCs and maybe the founders. And the founder may be very sure that what they're doing is going to work. They just need more time and they just need more money, right? So how do you have that conversation and get them to pivot or get them to reduce their burn when they're saying, we just, in order for us to succeed, we just need to go full speed ahead?
Well, I think it has a lot to do with monitoring your portfolio regularly. Like, if we're getting to the point where we need to have that conversation, that means that probably for the last 3 months or 6 months, things haven't been going according to plan. So if the founder is saying, no, I just need more time, it will go according to plan in the next 6 months. But if it doesn't, that's sort of an end of the road situation. It's like having that conversation. If you've been checking in and monitoring and working with the company, right, the founder along the way, they're sort of already seeing that signal. What are the KPIs and the things that they need to demonstrate to themselves, really, not to us. Like it should be them, the operator, that knows what are the signals that I need to believe in to know that I am going to get there over the next 6 months. And then communicating that with us, the VC, to come to some sort of middle ground where we all understand, like, yes, we agree. You do have these KPIs. We can see that it is going to go in a different direction. We believe that, and we're going to support you on that the next 6 months, versus that maybe we don't believe that those KPIs are trending in the way that you think that they are, the founder thinks that they are. And we need to start taking some measures to extend that lifeline even further. Like we need to do a reduction in force, or we need to rethink the strategy, or we need to pivot, or whatever it might be. And I think that's just like, that's an important role of a VC. And I think it gets overlooked a lot, because having VCs that were former operators or have run businesses themselves versus being just an investor, I think makes a big difference there. And it can also make a big difference with the founder too, like a founder's ability to trust you as a VC and be willing to take that guidance seriously. It can be hard if you don't have a background that is clear, that that what you're telling them is probably the right thing. So I don't know if that answered your question, but
I think, I mean, like founders are just like eternally optimistic, right? That's what you have to do, because it's a hard business, like to do this, knowing that most businesses fail, and it's kind of believing in yourself. I think a lot of them like to believe that if they can just get through this, it's going to be okay. And I think, as you said, being in a place where you can credibly guide them, I think is important.
Yeah. And in the example that I'm thinking of, this didn't work. We tried to get the founder to do a reduction in force. We knew that the growth just wasn't going to support the cash burn. It just wasn't working. So we needed to fix something. Founder, eternally optimistic, just believed that they were going to get there if we just had, another 6 months. And we didn't have a board seat in this company. So this was a sort of like a smaller investment of ours, but we were trying to, support it. Couldn't get the founder to do what we wanted, but what we said, and with the other investors on the board, we said like, hey, if you do get to the end of that 6-month road and you're wrong, we have to have a plan that we're all agreeing on today. What's going to happen then? Because you're going to need more capital. That doesn't match our investment thesis that we originally invested in. So it's going to be more dilutive. Like we're going to have to change some of the strategy of the business, because we've now gotten to the point where we know it's not working. For sure, you and I are agreeing, founder, because you just told me this is how you're going to succeed over the next 6 months. And then unfortunately we got to that point and he had to like face the reality that he was wrong. But I think that because of having that conversation along the way and talking him through it all the way, like really good founders eventually realize like where they've made mistakes. Like every founder is making hundreds of mistakes all the time. We all are. And the really good ones can recognize that and learn from it and, figure out how to move on from the company. So it actually is a positive story. We end up having to put more money into the company, but they did turn it around. They did change their strategy, and they are growing tremendously now. So it can be a good thing, I guess, in either direction, as long as the founder is willing to, take that feedback at some point.
But one thing about kind of, again, having that conversation is like, there are differences in alignment in terms of even between the founder and your investors, but even between different investors, right? So you may have investors that come in very early stage seed or, super early Series A, and their return profile is very different from somebody who comes in at a C or a D, right? So how do you navigate that when you've got a founder who is swinging for the fences, some guys who may be money good on their investment, and others who are like, well, this is not quite where we thought we were going to be.
Yeah, I think that's one of the hardest parts about the job. And I think that what I've learned along the way, and made many mistakes myself, is not realizing how important that is. And I think when you make an investment, you really do need to know the other investors that you're investing with. Like you need to get to know them and have open lines of communication with them from the beginning, so that everybody knows, even if you get in a situation of misalignment, you are ahead of it and you can kind of think of a plan and sort of get get buy-in around the table before you even get to that point. And so I think that's something I've sort of learned. And also just the governance and having a good board structure and having good board members and knowing who they are. Same thing. It's not all the board members are investors necessarily, but they're maybe the ones making the decision. So it's really important that you get to know those people when you make an investment, or you are a board member and you can influence the direction that some of those things go and try to figure out what the best way to align everybody is. I mean, of course, over time, like we're an early stage investor. When the company gets to the Series D stage, we keep our pro rata, but we have no influence, right? Like there's nothing we can do at that point, really. But I think it's more in the life cycle of where we are deploying capital and getting the company from early stage to growth or later stage, then it matters for us. And once they cross that chasm, that's pretty good. I mean, they've gotten pretty far at that point. So we usually feel we feel pretty good about that. And then we hand it over to the people who are writing, $100-500 million checks.
And it is interesting that so there are board meetings, but so much is done outside of those. And I think that's an interesting part of and you mentioned kind of the inside baseball, is that all the positioning and the kind of conversations and the kind of getting coalitions together to get people aligned on the kind of path forward that happens outside of those board meetings, so that those board meetings can actually be productive. That's been interesting.
That is a very good point. The inside baseball thing, because the board meetings themselves are just sort of like the formality of going over all of the things that you've been working on with the company and with the other board members and with the other investors all along, probably every week leading up to that moment. And I think people don't realize that. Like a lot of people want to be on boards, and I'm always confused by that, because I'm like, it's a ton of work to be on board. Like you can't. I don't understand people who are on 20 boards, because how can you manage that and be running a VC fund and doing all these things if you're doing a good job at all of them? Because you really do need to be having these conversations and getting alignment. And I'm sure you've been in conversations like that too, on the banker side, like when you're working directly with the board, right? When they're going through a transaction. And I would kick that back to you. I'm curious if there's examples of like good or bad examples of that where you feel like, it was working well or it wasn't really.
Yeah. I think it is one of those things where I think this is all board meetings, right? So board members should not show up and be surprised by anything on the agenda, right? So you should have done all the prep so that when they walk in, how the meeting's going to go, unless you want them to be surprised. There are situations where that is, there may be somebody who's not aligned or somebody who's you don't anticipate is going to be cooperative, but, unless you're trying to do that, the goal is to make sure that when people walk in, they're aligned on a game plan, and there may be discussions around kind of strategy and how you execute. But ideally, when you get into a board meeting, it's really, okay, we're aligned on where we're going to go and pretty much on how we're going to get there, but maybe the details on how you get there, because the last thing you want to do is be in a situation where people are just, you have a board meeting, you have a finite amount of time. If people are just going totally different directions, and one person's talking about maybe we should IPO, another person's talking about maybe we should sell ourselves, and another person's like maybe we should just do something completely different. That's a good conversation to have in kind of the early stages. But if you're still having that conversation when a decision needs to be made, that's just not going to be a particularly productive meeting.
How common do you think that is? I mean, that you've seen when you get to companies at the point where they're going to transact, they need to transact, they're working with bankers, they want to exit, and there's just like no alignment, and all of the board members are wanting different things, and you can't even get to a conclusion quickly enough to transact the company in a positive scenario.
Well, I think that's where I think something's gone wrong, right? Either the founder needs to have taken or whoever the CEO is, or whoever's kind of leading the company needs to have taken a much more active role in trying to get people to where they need to be. Or maybe you're allying yourself with some investors on the board who have a clear vision of what needs to happen. It's very rare that there's like all the options are completely equal, right? There's usually a better option there. And the question is, how do you get people to that place? Or if it really is like these are three completely good options, then it's like you have meetings and you have that conversation. But, normally that's not the case. It's, don't align with what appears to be the best option. There are usually other things underlying that, right? Either there's different incentives for them, or there's something else going on. And I think you just have to figure out what that is and then address that. Because if you don't do that, then you're going to have that misalignment. Even if you try to line everybody else up, you've got people who have differing interests, and they're going to continue to go one way unless you address that.
Yeah, I mean, I think the biggest takeaway from all this is just, communication is the most important piece. It's early and often, both for the founder, the CEO, but also for the investors and the board members. That's a big part of your role in all of this. And the more early and often you have those conversations and understand what is happening in all of these different stakeholders' lives, businesses, that can influence the way that you put a strategy together to move forward, and it can lead to a much better outcome in most cases. So, well, I want to maybe switch gears a little bit and ask you, what is So what's the most interesting inside baseball thing you've learned about the venture capital industry?
Um, you know, it is interesting because one of the things that you see in private equity is that there are a lot of kind of copycat deals, right? Where people kind of say, okay, we hit on this strategy, and then kind of everybody else floods the market and does the same thing, and then eventually that peters out, and you kind of see waves of that. I guess didn't expect that as much on the VC side, but I think there is some of that kind of copycat behavior as well, where you kind of have people say, okay, well, we're going to invest in this sector, and everybody kind of floods that sector or floods that type of company, and then but that's the exclusion of other companies, right? And those kind of get underfunded. So it's interesting that it kind of moves that way, kind of that herd mentality, which seems like it, from a return perspective, doesn't seem ideal, right? Because there can only be so many winners in a particular space, and you're betting on a number of different companies, or maybe a lot of different companies in that space. Economically, you think that there's opportunities elsewhere, but the problem is that when those companies don't get funding, they're in those other spaces don't get funding, they're just not able to proceed. So it's an interesting dynamic, right?
Yeah, and it's a good point. Like right now, you're seeing it probably with AI, a lot of AI and defense tech. People are all of the what had been historically been B2B SaaS investors are now like defense tech investors.
Okay.
So, but you're right. I mean, it is very common. I think for us, we focus on regulated markets intentionally because we know that sometimes there's more interesting and there's more tailwinds around one regulated market versus another. We want to be able to pivot between them, but without getting FOMO and getting stuck into the like, okay, we're just going to do entirely AI and exclude, all 6 of the other areas that we normally would invest in, because then you're missing a ton of good opportunities and at good prices. Like the FOMO, VCs have a lot of FOMO. I think that's the problem. And, the space is hot and, other VCs getting into it. You feel like you're missing out. You feel like you need to be in it too. And then that drives the prices up of these companies that that are in that particular hot sector at that time, which may or may not be a good thing for them, in a lot of cases. So, but it's true. Like we have historically never done this in the last 10 years. We've always done deals across multiple sectors every year, what the trend was. But we do know a lot of our co-investors, we do see this like quite common. I actually feel like it's an advantage of ours because then to your point, those other companies that are getting underfunded, if you can get them funded and they succeed, then probably got in at a lower price point and you're getting, sort of access to better opportunities that way.
Yeah. I mean, the danger is that they don't get the funding that they need, right? And you see this a lot in kind of the biotech space where, people flock to certain therapeutic areas and they kind of to the exclusion of others. And it's given the amount that you need to raise for some of those companies, even if you get in early, you do need other people kind of there aligned with you in order to get it over the finish line. So there's the danger that you're investing in the right company with the right business model, but they just don't have enough. They're not able to attract enough financing to actually kind of turn the corner and succeed.
Totally agree. I mean, that's what part of our thing is that we want to make sure that the entire round is actually closing with not just us in it every time. Otherwise we won't do it because it just makes it too difficult for the company. I think that's a really common thing with climate tech right now, but you watch the pendulum swing. I mean, it is interesting, like in healthcare too. You're seeing a lot of like the FDA approval type biotech companies just with the regulation risk right now, just not getting the funding they need. And that's a really big problem for that, especially because to your point, really big check sizes. So it's harder to do it in that area for sure.
And that's a space that's been kind of facing some headwinds for a while now, especially on the public. I mean, that's been tough.
Yeah, that's one of the few regulated markets we don't invest in because of the check size, because of the amount you have to put into it, and because of we just don't have the expertise in the FDA process or the medical, frankly, process to be able to evaluate them. But okay, so my next question for you is, what is your biggest failure, would you say, and what did you learn from it? And this doesn't have to be about venture, but it could be about anything, but it's about venture.
Yep, interesting. So I think it's that FOMO, I think that you had mentioned before, right? Because you think about the ones that you passed on and you're like, oh, why did I do that? And then, does that spur you to kind of chase something that you shouldn't have chased, right? And I think that there is that kind of fear of missing out. So it's kind of trying to remain disciplined in light of kind of the fear that you're not going to get the next big thing. So I think, it's like in baseball, right? You reach for a pitch that you shouldn't be reaching for because you're kind of in a situation where you're like, maybe I shouldn't have let that one go, but maybe I'll chase after this next one. So I think, from a personal investing standpoint, I think I've definitely done that. And it's something that you just have to kind of rein in and make sure that you're investing on kind of the actual fundamentals versus like kind of sentiment.
That is our motto at K Street, is that we've always invested based on unit economics and product market fit, and not. And I mean, we've made mistakes. Everybody has. I have myself personally too in picking meals. But if you just try to stay true to that core set that is really your investment thesis, and let your meander by the sparkling objects around you, which is hard, but you learn from it when you get burned from it.
Yeah.
So yeah, I think that's a great lesson. And then the last thing is, what's the best advice you've ever received?
So I think this is coming. This is when I was a junior associate, and I think you got to hear various versions of these. So as a lawyer, and you kind of hear kind of various versions of this, but people like the gist of it is that people aren't interested in excuses, right? And I think at the end of the day, like, nobody really cares why you weren't able to do something. They just want to know that you can get it done, or that you didn't get it done, and that is what it is, right? But I think that kind of, I think everybody kind of likes to tell themselves, okay, well, no, I didn't do that because of X, Y, or Z, and you try not to be hard on yourself. But at the end of the day, like, people aren't really interested in why you didn't get it done. They just want it done, right? So
That
yeah.
that is, I often say that myself as one of my best pieces of advice that someone gave me in an internship. It was actually like a manager of a PE fund, but I was like 18 years old and I was doing odd jobs for him, literally like taking his dry cleaning to like in college. I was just needing some extra cash, and I was doing all kinds of odd jobs. And at one point I was like, yeah, I couldn't figure this out. Here's where it stands. I didn't like a rebate on a vacuum cleaner, and I just couldn't figure out how to get the money back. And I was like, I can't figure it out. What do I do next? And he was like, I don't care. I don't want to hear about this. Either tell me that it's done or it's not done. Like, and then we move on. Like, give me I don't want to sit here and like think through all these things. You're putting the work back on my plate. I don't want the work back on my plate. The work should be on your plate. And that was like a great lesson to learn, at that time. So totally agree. But anyway, I know we're coming up on time here, so I really appreciate you doing this with us. I think this is a super interesting episode. Are there any final thoughts that you have or want to share, whether it's about the topic or venture in general or anything?
No, I think I think it will be an interesting venture market over the next through the rest of the year. So it'll be interesting to see what happens. One of the things that in terms of exits is, what do you do when the public markets aren't there? Do you do M&A? Do you do combinations with other companies? We're seeing a good amount of that, where two companies who have similar businesses come together and combine because there just isn't an exit right now, or they view the market as being not big enough for both of the players. So it's a way to kind of find a path forward when there aren't a lot of other options there. So again, it kind of goes back to the idea of, okay, well, how do you have that conversation, and then making sure that you do it with enough lead time that, when you're coming together, that you actually are able to come together, and it's not one acquiring the other, that you may be doing kind of a true merger equals versus like one company being distressed and kind of having to sell to its competitor. So
That's interesting, actually, because we just had one of the portfolio recently. You probably know the company I'm big, but we're starting to see more of that too. These sort of even-sided mergers, and I guess is this a way? I guess this is the way for the companies to continue on their journey, because the public market's not there, but they're really getting close to, like, they should be IPOing probably, but they can't, and they have antitrust issues, so they can't get bought easily at that size, and so they just do they're doing these kind of mergers to just keep growing and keep pushing out the timeline to when the public markets ultimately do open up, and then they will go public. Is that kind of what you're?
I think that's the goal. Or I think there are more companies thinking that they're just never going to go public. If there are a couple of them out there, but given some of the liquidity that these secondary markets can provide. I think some companies are saying maybe we don't need to go IPO if we don't need the capital. I think that's the challenge if you can't access the public markets and you're concerned that the private markets might dry on point. But
Yeah.
same thought that I don't think had been on people's minds, 5 years ago, that we're just going to eternally remain private.
Yeah, I think it's a really interesting trend that might be much more common. We've invested in 75 companies, and we get emails all the time from secondary buyers wanting to buy out our positions. So I should have brought that up earlier, but this is another way. Like maybe it's kind of like the real selling your project, but you're selling it at a major discount. Like it's very discounted,
Yeah.
and that's I think the pain. But maybe it's the same pain with the product jacket, like losing that discounted amount you already paid for it, but what you think it's really worth. But that is an option. That is another option for exiting as a VC.
Yeah. Hopefully it's in the situation where it's actually appreciated, but yeah.
I think what you're talking about, what you were mentioning, is like another company just stays private and they're doing well, and then when you exit, you're not taking a steep discount,
Right.
getting what's worth. So it's just a way to make the private markets liquid. And I mean, that's an interesting trend. I've always thought eventually, like when companies stay more private, like the public markets have been the place where everybody puts their money historically in general. But is that going to change where the private markets become more liquid because there are more players and there are more secondary types of options, and it makes it a lot easier for everyday people to invest in the private markets on a more regular basis. And if those companies are staying private for permanently in a lot of cases, and that becomes the trend, then I think we might start to see a lot of that.
Yeah, and it's an interesting dynamic, especially since you're seeing also kind of the retailization of private equity as well, where regular investors can invest in basically private equity funds in a way that I don't think was really accessible 5-10 years ago. So that's something that it's kind of that, to your point, it's that kind of move where even smaller investors are able to access kind of alts and other investments that were previously a little bit higher threshold or more difficult to access.
Yeah, exactly. And I think that'll be a good thing. It's when that happens, when that day comes eventually. I do think it will. And we're already starting to see it. So it'd be interesting to see how that evolves.
Yeah, Reg A didn't really do as much as I think people thought it was going to do, but I think there are other trends that I think are actually making make it more democratic in some ways.
Yeah, Reg A, which one is that one?
That's
the
crowdfunding.
one, right? Okay. Yeah, that didn't do as much. And then I guess the accredited investor, they're trying to change the rules around the accredited investor requirements for certain things, which I think it's good. I think they're finding ways to make that more efficient and sort of change the requirements around it, which would be a good thing.
And some of the platforms are better about kind of trying to streamline that as well. So that's been a plus.
That's true. Yes. Well, cool.
Yeah.
Well, thank you so much, Tony. I think this has been incredible, and thanks for your insights. I think our whole audience will finally get some answers on the sort of like Prada jacket equivalent transaction situation.
Well, it's been a pleasure, Steve.
Likewise, Tony. Cheers.